This week, Rachel Reeves has announced new tax plans, and I'm going to cover one in particular, which is the most worrying one on it. Okay, the source here is Times, Knight Frank and the FT. The government is already considering a shake-up of property taxes in the budget this autumn as it tries to fill its multi-million-pound black hole in public finances. Many options are being looked at, blah, blah, blah. The Times reported on Wednesday that the Chancellor was looking at considering charging capital gains tax on the sale of main homes worth 1.5 million or more. This would be on top of stamp duty paid by buyers. Okay, stamp duties raised 13.8 billion last year. Capital gains tax would raise the same again. So it's obviously a cash cow for her. Is it a good idea? Well, Jonathan Branding Harris from the estate agency House Collection says handing sellers a large CGT bill on sale would simply discourage them from moving, and that's true enough. George Wolford from the estate agent Wolfords said it's the single worst decision any government could make in the housing market. It would grind activity to a halt. Instead of boosting treasury receipts, it would kill them off completely. How would it work? Basically, at the moment, your main home is exempt from CGT. If it wasn't, the treasury would make 31 billion from that. CGT is charged on 24% for higher rate taxpayers and 18% for base rate taxpayers on the sale of assets, which is second homes, shares, art and that sort of stuff. So by not charging CGT on the sale of main homes, it costs them 31 billion. Blick Rosenberg say abolishing this relief would be hugely controversial and would mean the end of principle that no tax is payable on the sale of your family home. Tom Bill said that because CGT is only taxed on some sales, many homeowners would simply decide to stay put, i.e. if you got a family home, why sell it? If CGT, he says, is applied from when the property was last bought, it would divide sellers into two groups, those sitting on a gain and those who are not, completely skewing the market, he says, which is quite right too. So that sort of idea of capital gains tax on your principal residence is very unpopular. We'll see how that goes. Positive news, mortgage rates are falling steadily. Average rate on a 5-year fixed mortgage dropped below 5% for the first time since May 2023 last week. The average 5-year rate hit 4.99% on Thursday, 5% a day earlier, according to Moneyfacts. Although it's only a small financial saving, it marks a shift in sentiment, which is what I always bang on about. What people think, their confidence, whether they think it's a good idea. And Moneyfacts describe such moments as this as a symbolic turning point in the marketplace. So that's pretty good. Even the smallest rate drop can boost buyer confidence and spur greater competition. And I hear it all the time. People say, oh, rate's really high, isn't it really bad? And then you hear, oh, there's been a rate cut. Is it a good time to buy? You know, people who are working in the oil industry or high net worth people who don't have time to look at this sort of stuff, they're easily swayed by small amounts of information. So a small drop and the fact you can get rates below 5% is a great thing. Average 2-year fixed rate, it's the first time it's been below 5% since 2002 when Minister Truss had a little package. It fell from 4.9% to 4.8%. Adam French, head of news at Moneyfacts, said the latest data was more welcome news for borrowers and it showed lenders were competing more aggressively. The slow and steady fall of cost of borrowing is good. However, the latest inflation figures of 3.8% have come out are bad because it means that potentially stop the chance of seeing another 2 rate cuts this year, he says. It may be just 1 rate cut. As a result, a few of the modest rate reductions are the best borrowers can probably hope for in the short term as lenders adjust to the prospect of higher rates for longer, Mr. French added. Lenders are also offering more choice with 7,000 packages out there now, up from 6,000 the previous day. So there's nearly 1,000 more in one day, which is phenomenal. I mean, the point being with all this, though, is that if you've got a whacking great deposit of like 60%, you can get rates of down at 3% anyway. So it's not necessarily, these aren't such great rates. But if you look at it, the more money you have, the better rate you can get. So that's an important thing to bear in mind. Now, if the market is picking up, I thought perhaps this week we'd look at where is a good place to buy? Where are good locations? So this week I did a bit of a spotlight on Birmingham because I do think it's a good place to buy. And we saw from last week when we were talking about rental returns, they're still going up in the East and West Midlands. Why is that? Okay, and there's a variety of different factors, and I'm going to read them out because it's important to get everyone correct. There's a pipeline of large-scale mixed-use schemes coming forward, 65 with planning secured for 100 plus units to be delivered over the next decade. These developments will provide nearly 8,000 new homes, new retail and commercial space, according to Molières. Okay, Birmingham's GVA, a measure of the value of goods and services produced in an area, is forecast to increase by 19% to 40.6 billion by 2035, according to Oxford Economics. So the place is really banging from a perspective of economic output. So you're going to get people moving up there to get involved in that. The ratio of median house prices to median workplace earnings in Birmingham stands at 6.6, below the national average. Okay, so that's earnings to house prices is 6.6. The average for England and Wales is 8.1. So you get better value for money in Birmingham than you are getting in other locations. Over the past decade, rental demand has increased in the city. Out of all Birmingham households in 2021, 22.6 rented privately in 2021, up from 17.9%, okay, and up to 24% as of 2024, according to census. Headline rental headline rental growth for PBSR, purpose-built student accommodation, went up by 6.7% for the academic year of 2024, according to Knight Frank. Across the UK, it's been 5%, so it's much better. And then finally, there's been an uptick in high earners moving from London to Birmingham. Data from Experian suggests that the number of movers earning over £70,000 a year increased by 20% compared to the year before from last year. So that is pretty strong. So that's why Birmingham, we think, is a good market to buy in, and we put a lot of clients into there, and we like it a lot. It hasn't gone to stratospheric levels that you've got in London or you've got in some parts of Manchester. It's still a fairly priced deal. Okay, question for this week, just the one. Michael P247. It's absolutely embarrassing for a grown-ass person, don't know why I say grown-ass, but he had a very small ass staff, with or without a family, to need to Airbnb a room in their home to make ends meet. The UK GB is an absolute mess of a place. I used to Airbnb a room in my house previously, then all of a sudden Airbnb emailed all hosts and said that they need to supply our real names, date of birth and national insurance numbers. HMRC have made it mandatory to now report all Airbnb earnings if they use one of their rooms in a host to host guests. HMRC are coming for tax. The UK GB is beep, beep. Use your own proper name, that's probably not a bad thing. You are getting earnings, so you should pay tax on it. To be fair, mate, it's a bit draconian, yes, but, you know, it's like anything, isn't it? If you've got an ice cream van and you're using it at the weekend to make money, you've got to pay tax on it. It's only fair. But I do agree, as a general picture, it's pretty shocking. I had a WhatsApp from a friend of mine who runs an embroidery business in South Wales, and he said, the place is a mess. I'm getting taxed to the hilt. I can't afford to live here. Where should I emigrate to where I can take all my money and I don't pay tax? That's just a random thing from a guy I know from doing some embroidery work for me. Crazy. Where should he go? If he can put it with it, Dubai is very tax-free. He can see out the storm because his labour storm won't last forever. Okay, that's it. That is the market wrap for this week. Thank you very much for listening. I do hope you enjoyed it. Do take care. All the best. Bye-bye.